Hi everyone, welcome to Finance at JCL. Great to have you here and thanks for joining me. Today's update is a stock review and I'm going to be looking at Alibaba. Thanks to Luke who recently requested this one. It's great timing actually because there seems to be a lot more talk about the company. It is a company in my portfolio, so I thought it's a great opportunity, the request to have a look at it. Right, so we're going to start off in the usual way, and we're going to have a look at the financials on Morningstar. Now, the first thing to note is the currency. It is in Chinese currency here, so you just need to be careful of that when you're doing any calculations. You can see here absolutely incredible revenue growth. You're looking at something here that's 100 times bigger than it was 10 years ago, effectively in revenue terms. So it's incredible growth. The Chinese Amazon, many have termed Alibaba. The net income has always been there. It's been a profitable growth company, and it has been growing very considerably. You can see that's a decent margin percentage there. Earnings per share as well, also growing very nicely, particularly in the last few years. So we look at that thinking it's definitely in that fast grower Peter Lynch category. So we're expecting something that probably doesn't pay a dividend or buy back shares, which is certainly the case here. And in fact, you can see the number of shares in issue has increased very slightly each year. So that's something to watch out for. Now we've established the type of company, it's time to say, is it likely to fail? And I think with this one, it's pretty straightforward. You can see the current ratio is always well above 1. So that looks good. And the debt to equity, see along the bottom here, is very low. And in fact, it's the lowest it has been for many years in the most recent period. So chance of failure, at least from a financial perspective, appears to be low. Now, I know we can't rule out the regulatory risk, but yeah, it looks like this could be a good holding. A growth company has a low chance of failure that is profitable. You can see here the net margin figures above 20% consistently in recent years, and a good return on equity as well, which is a very important metric. So on the face of it, looking at the sort of company that it is, and the low chance of failure, this would look like a buy. Let's try and pull together a bit more information to see, is this now the right time? We look at the information on SWS here. So earnings have grown very rapidly in the last 5 years, but they're forecast to slow down to sort of 11% a year. That is something to watch out for. The revenue is expected to over double in the next 5 years. And the net income, not earnings, not quite double in that period. So the margins are expected to drop off a little bit in comparison to where they are today. No insider trading that we're aware of, and you can see the ownership structure of the organisation. In fact, SoftBank is by far and away the largest individual owner. Now, looking at the Yahoo information, you can see they're currently at a PE of 27, but 4P of 19. Now, the important thing here is that people say it's the Chinese Amazon, and if you look at Amazon, their current PE is 65 with a forward of 47. Now, you'd expect Alibaba to have a discount to those numbers because of the fact that it's Chinese listed. Nevertheless, a 4P of 19, even a current P of 27, does look relatively cheap. And we see the market cap here is just over 600 billion, whereas Amazon, you're looking at 1.7 trillion. So Amazon is almost 3 times larger in market cap. Now let's have a look at the price chart. And if we have a look over the last 5 years, you can see there are ups and downs of the stock. And there was a peak towards the end of 2020 at getting on for 310. And we've had a bit of a drawback recently. It went all the way down to 210. You're dropping off a third there, which therefore means the upside to get back to that peak, assuming that is where it's going to go, is 50%. So I think there's at least a 50% upside on this, even just to get back to its relatively recent market valuation. And we have a look for the back pocket, the Simply Wall Street estimate. That's actually exactly the same level at 309. So again, it's suggesting a similar thesis. So what I'd like to do is actually do my own calculation here. So what I have pulled together here is a template. I'll zoom into this a bit. So if you are considering joining the Patreon, I've got a copy of this template that you'll have access to. And it's meant to be a simple discounted cash flow method intrinsic value calculation. So the idea is we look at the free cash flow the Alibaba business will generate, we'll discount it by our required rate of return to look at the discounted cash flow. And then from that, we can work out, based on this discounted cash flow, what the value of the company is. Now, the first thing is, I've just had a look here at the exchange rate, which is 1 to 6.46. I've included that into the calculator because the figures that we saw on Morningstar are in the Chinese currency and not in dollars, which is the listing. So we're going to start with, we're going to look at perhaps a 10-year forward simulation. And my discount rate that I like to use is 10%. Now we're in a relatively overvalued market, but I do want to achieve 10% because there's no point really aiming for lower than that. Otherwise, you just buy the index. Important value then is the terminal multiple. So we're looking at forward PE. So we had a forward PE there of 19. But I'm going to go with 25. So I think Alibaba will trade at a PE of 25 in 10 years' time. I'm looking at that based on looking at Amazon's PEs that we saw, and also they're at 27 today. I think 25 is I could see that happening. Market cap in millions, I've popped in there in dollars, and the share price is $229, and the number of shares there is 2710 in billions. Now, the next information to add in is the starting free cash flow, and that is the figure I've used here of 164,381 in millions, and that just gets converted into dollars. And just for reference, today's PE is 27. So the final thing to input for the calculator runs through is actually for each of the years, the next 10 years, what growth rate do we think is going to happen to the free cash flow? We saw the analyst view of 11% for the next 5 years, and I think that's certainly achievable, maybe even relatively conservative, but let's go with that. If we said 8% a year after that, the final 5 years, that then looks at the starting free cash flow, multiplies it by the growth rate each year. So you can see the free cash flow goes from $25 billion to $63 billion in 10 years' time. I think that as a sense check, passing the sniff test, that sounds reasonable. Discount rate there, 10%. So you can see all those values discounted. And the sum of the discounted cash flows is 282 billion. And with our terminal PE effectively of 25, we take the discounted cash flow here in the last year, times that by 25, and then that gives us 2/3 of a trillion. And if we look at it in sort of raw terms, we're saying 1.5, 1.6 trillion. So could Alibaba be valued the same as Amazon is today in 10 years' time? I think it could. So that's our little sense check. So you add all those up, so you add the discounted cash flows up, and then that effectively PE of 25 in 10 years' time. And that gives then, divided by the number of shares, an intrinsic value per share of $350 per share. For me, I've already got it in the portfolio, and my average is actually lower than the current price. I think my average is 210 or so. So I think relatively conservatively, with PEs that are certainly much lower than Amazon's PE, I think Alibaba is worth $350 per share. So $350 would be what I think is a fair value. So I did top up my position relatively recently, and I posted that on the Patreon because whenever I buy or sell, I post on there, and it would sort of feed through into the monthly updates that I share with you. I think you need to then decide. I think it's a company that's worth buying in terms of the actual company itself, but you need to decide, is that upside right for you? Is there a good enough margin of safety? I think there is a good enough margin of safety. So for a 10% return, it's looking undervalued. I hope you found that fairly interesting. And if you are Patreon site and supporting the channel, you can see when I'm buying and selling on the entry level membership, and you get access to the discounted cash flow template, simple version there that I just went through. So I think that's pretty user friendly. Okay, so thanks for joining me today. Excellent. If you've got any other requests, I'd love to hear them. Otherwise, thanks for joining me and have a great day.